You're 60 years old, married, and working with $2.2 million built up in your 401k. The question becomes, should I consider converting some of this money into a Roth position? That's what we're going to look at on our video today. Hi, my name is John Vandergriff. I am one of the owners and wealth planning team lead here at Blue Ridge Wealth Planners, where we help people create plans to effectively retire and cover their bases, but also if they're already retired, making sure that their planning catches up to their stage of life. And one of those key areas that we look at is the area of tax planning, which is where we're going to focus today, and some of the things that that covers. Because as we look at this as planners, what we realize is that not everything is siloed. There's a lot of carryover into other areas. So we're going to look at a particular situation today, but I want to point out a few things before we get started. First, if at any time you have questions, you realize this is a conversation that you're not having now and you would like to have, you're going to see a link below that gives you access to our calendars where you could schedule a time with one of our wealth planners here at Blue Ridge Wealth, and we can talk to you about some of these conversations that we're having, see how this could apply to your situation. With that being said, I would caution you not to take this and run with it. You need to make sure you have all the information at your disposal. So contacting your CPA, making sure you have all the information, and also working with someone hand in hand to make sure you're not missing something in this realm of tax planning. Very important. And then lastly, as you watch this, if you have questions, jot those down, comment those below. But if you like this, subscribe to our channel, share this with other people so that we can get the word out on tax planning and how this can benefit those transitioning into retirement, or really anybody who may have a low tax opportunity today. So what we're looking at, a 60-year-old couple, married and working with $2.2 million in their 401k, even with that much and still working, should they consider a conversion to a Roth? That's what we're going to look at. And as we said, you know, the conversation is not just about taxes. Really, to create a well-rounded plan, you need to be covering taxes as well as the income planning, investments, healthcare, and family and legacy. Most of the time, people don't have these done in one direction where all these pieces are coming together. So that's where a lot of times we're able to add value to the families we're working with and make sure that all these things are in alignment as we move forward. So we're going to focus primarily on the income and taxes conversation, but that doesn't mean that the other three are not important. We're just going to make sure we focus on that today. All right, so married couple, both 60, so again, makes things a little easier. What we have today is a situation where there's $110,000 in combined income, and you're going to look at Social Security and say, well, gosh, how are they able to get that much Social Security with that much income today? Really, this is a situation where you would want to think of it almost as a phased retirement. So this particular couple could be consulting with $110,000 after their career. You know, again, everybody's situation is a little different, but they're planning on continuing to work for another 10 years at the pace that they are. Their income need at retirement is $110,000 of net income with inflation factored in. So again, obviously a bigger number once they get to 70. Combined Social Security at 70 would be $7,300 a month, so makes up a substantial part of their income need. And then from an asset perspective, they got $2.2 million in 401ks today, another $600,000 between bank accounts and other non-qualified or after-tax positions. So as we look at this, going into our particular situation here, want to write down, you know, what we're looking at. So obviously $110,000 of need. This is a net need where this would be gross. So again, you know, they may be pulling off minor monies, but I'm sure whatever their need is for taxes may be generated by dividends off of this $600,000. So again, that's where, you know, from an investment planning perspective, we can look and see if they actually need something from their portfolio today. But once they get to Social Security at 70, these would be the values. And again, you know, $110,000 of wages until then, so really not a big need to take Social Security until that point, unless, you know, Social Security brings about changes, which could happen, and that's where, you know, making sure that all these pieces are fitting together really can add a lot of value. But going over to here, at the $110,000 of taxable income and the way that we look at it, that would put them at a top tax rate of 12%. Now, the top tax rate is important to point out because if we do any kind of conversions, that will be the starting point of any money coming out of a 401k, and we'll go from there. So obviously we'll point that out as we go through the video. Really, at the end of our time, we'll look at some recommendations there, but we need to recognize that 12% is an important number because that's the starting point for where taxes are paid today. So 2.2 million in pre-tax, 600 in after-tax or non-qualified, $0 currently in tax-free accounts like a Roth IRA or properly structured life insurance plan that gives you both tax-free growth and tax-free withdrawal. So again, some of those can be very important pieces if used appropriately. So as we get into this, we want to talk about obviously what matters in evaluating this decision. And so one of the things that we look at is whether they should leave this money in the 401k from a fundamental decision, or they should take this money and move it into either a Roth 401k or a Roth IRA. Not everybody has Roth 401ks in their company plan. So typically to make this migration happen, you may need to convert this to an IRA, then get it into a Roth position. But as we look at this, we're just going to look at the math here and see from a fundamental perspective, does this make sense? So for round number's sake, let's say we're looking at $100,000. We're going to look at the path if that money stays in a 401k versus if it was converted over to a Roth. Is that a good decision or not? And obviously it depends on the total picture here. So, so as we look at the 401k, $100,000 stays $100,000 because it continues to grow tax deferred. The Roth triggers a taxable event, as we said, of $100,000 on top of their income today. So again, in this particular situation, the starting point would be 12%, then would go to 22%. Since we're going to have more dollars on the 22% side than the 12, let's just overshoot our mark and say 20% would be the tax impact. I know it's probably not going to be that much, but if you withheld that, you would have a Roth account that starts at $80,000 versus a 401k account that continues to be at $100,000. And a lot of times when I talk to financial advisors and they bring up this conversation, a lot of people will recommend not to do Roth conversions because they're looking at this equation and saying if the market goes up, this is a bad deal for the client. 10% growth in the market would yield 10% or 10,000. It would only yield 8,000 over here. Well, we've got to recognize those are not the same 10% because this is 10% taxable versus if we structure this correctly, 10% of tax-free growth. And again, the rules around this, as long as the Roth is in place for 5 years, you get tax-free growth on whatever's converted plus tax-free withdrawal after that 5-year window is over. If you're over 59 and a half, the basis is available to you, but the growth would still be taxable. So as we look at this, that is a little bit short-sighted recommendation. So we've got to make sure we play this thing out so that we've got an apples for apples comparison, which is once these monies get to be at least after tax, not necessarily tax-free. So as we look at it, let's assume we're investing both of these the same way for the same length of time. That way we are truly making this about taxes more than anything else. You see the Roth account grows to 160, the 401k grows to 200. Then we've got to look and say, okay, once we start taking this money out, whether it's by choice at retirement or by mandate, which there's no RMD requirement here, there is off of a 401k at age 73 today. 10 years from now, that would jump to age 75. But again, with the Roth, no matter how much you take out, as long as this has been in place for 5 years, you have the full 160 at your disposal. The 200, it depends. It depends on what the tax impact is at that time. And so let's say the same tax bracket exists in your retirement years as it does today. What's interesting is you look at the bottom line scenario with these, it's exactly the same. 160 both sides because the tax bracket stayed the same. So that's what we need to be evaluating is now the time for you as an individual to have the lowest tax bracket, or will it be later? Because the traditional advice when it comes to retirement is that you won't have the lowest tax opportunity while you're working. You will get that in retirement because your income will be lower. Lower income means lower taxes. The problem is you're not guaranteed that. There have been plenty of times, even adjusted for inflation, where your income would have yielded a higher percentage tax, even though that income dollar is less than where those dollars are today. So if it did work out and your taxes went from 20% to 12%, you actually have a better situation by not doing the Roth conversion today, because you would have more money in the 401k net of taxes than you would even with tax-free growth on the Roth side. I don't know how likely this is for most of the people we're talking to, though, because of what's happening in Washington. From a spending perspective, we have overspent for a long time, which has caused us to accumulate over $31 trillion of debt. As we look at that, that's not something that's going to go away overnight. So the way that that's ultimately going to get solved is through some growth potential, but quicker than that, tax increase. And not to mention issues with Social Security and Medicare, which will also probably require some tax increase as well. So if taxes do go up from where they are today, Roth conversion made sense at the time where the tax brackets were the lowest. Okay, so as we look at this, very simple example, but meant to show you what we really need to be evaluating. And so with that in mind, we need to look at where are we today. So again, 2023 tax brackets for married couple, standard deduction factored in already. So again, you know, the top of the 10% bracket would be at 49. This couple being at 110,000, they would not exceed the 12% bracket if they did nothing. If we did any conversions, it would start at 12 and then progress through, depending on how much we convert. We've got to compare, though, how that is, and we can't see the future, unfortunately, but we can look backwards and see, based on the way the rules are today, but also where we have been in similar times, what could that tax scenario look like. So for this particular example, 2017 is when the brackets were in effect. 2026, if nothing changes, these brackets will become relevant again. So what we did is simply just adjust these for inflation between 2017 and now. And if we're in that, this couple at $110,000 is right at the top of the 15. I mean, almost out of it. So really any movement would actually probably trigger a 25%, but between that 15 and 25. And then 1981 is a year that we look at because this was the last time that taxes were significantly higher than what we've gotten used to really for the last 4 decades. You know, as you look at these top brackets, you've got 39.6 in the 2026 numbers, 37% in the 23 numbers. As we look at the bottom line here, 70%. So almost double where we are today. And as we look at this income source at $110,000, that would be more than double where that bracket is, and then any movement would obviously increase that depending on how much money came out. So as we look at this, you say, that sounds great, John. What are we actually talking about? Well, basically, if we started Roth conversions today, the starting tax would be at 12%. If we did nothing and we're just taking out, in let's say 2017's brackets, as we said, is also 2026, was to be something that long-term we had, you would have an increase from where those are today, anywhere from 3 to 13%. So again, more tax percentage, less money stays with you, therefore it's a less efficient decision there. And then if things got to where they were in 1981, you're looking at 28%. So I think reality may be somewhere between these two. We don't know. All I know is, you know, based on the way things are today, this is a conversation that we want to entertain based on where we are, but also where we think we're going to be from an income perspective. And with that in mind, we want to look at something that is important because we have to recognize that there is going to be a significant impact of RMDs because this couple has $2.2 million today, and if they did not contribute another penny to it and just had 5% growth from 60 to 70, and then let's say they need to supplement their Social Security, so let's say they have a net 3% growth after they take distributions out, their 401k balance would grow from 2.2 to almost $4.2 million. And then the RMDs needed at 75, because again, we're more than 10 years out in the future, would be $168,867. So if we add that to the taxable portion of Social Security, that would give them a taxable income of $243,336 in retirement, which most people think their income is going to go down in retirement. This is not uncommon for us to see RMDs force people to have much higher income on paper than they actually need or want to pay taxes on, for that matter. So again, with that being 15 years out, I put a range here just because 12% would be the starting point for where Social Security is, but then the RMDs would pay taxes anywhere from 12 to 24 or 15 to 28 as we look at the 2017 brackets, or if we get to 1981, starting point at 21% all the way up to 54%, which is pretty incredible, and not in a good way. Because again, Social Security would start at a little over the 76 number here, so 21, but then as you see here, would escalate to that top bracket at 54%, which seems far-fetched, but we've been there before. So again, as we look at this, we've got to look and say, okay, well, based on where the things are today, what's a number or a recommendation that would make sense to convert? Because again, we may have a limited window of time if that 2026 time frame does hold. And so as we look at this particular situation, I think everything we can convert at 12% is a no-brainer. I would also recommend them maximize the 22% and then the 24%, because they're under age 63, there's no Medicare impact to this. But that is something that we need to keep in mind as people get into that time frame where the income decisions they make will affect their Medicare decisions 2 years later. But for this particular, if they did 281,000 and change of conversions, the effective tax rate on that would be 22.9%. I think that will probably be a discount, and honestly, it may be a situation where we would actually look at maybe doing a little bit into the 32, but once you start adding 32 in there, this number starts to increase pretty quickly. So again, maybe maxing out that 24% and everything under it could make sense for this particular situation. So again, we've talked here for 10, 15 minutes. If you've not had this conversation with someone yet and you're working with them, you're probably not going to. Because again, this is something that we talk about first meeting with a lot of the people that we're meeting with today. And so if you're not having this, you could be missing out on an opportunity to make your picture overall more efficient. And so we want to extend the invitation. If you would like to talk to us, either virtually, phone call, in person, we're here in Tennessee, so a lot of places can get here by vehicle or internet very easily. Click the link below this video where you're going to see our calendars. Pick a time that works for you. We'd be happy to sit down and see if some of these things could be a match for you. Because again, this is not a no-brainer for everybody. You do have to look at the details of your particular situation and make the decisions accordingly. So with that being said, hopefully you enjoyed and learned some things today. Again, leave us some comments, like the videos. Subscribe to our channel so that you can get plugged into the content that we're releasing on a weekly basis. But until then, that's all we have for today. Thank you for joining us.